Welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, I am joined by Tim Sustak, the SVP Chief Treasury Officer for Vizo Financial, and Scott Wood, SVP Chief Investment Officer with Vizo Financial. So, gentlemen, the last time we met, I promised to talk to you about the new administration and the impact. So I'm going to change things up and we're going to start there this time. And then I'll ask you about the FOMC meeting for next week. So Scott, I'm going to start with you. So in terms of fiscal policy, a $4.5 trillion tax cut passed in the House, which is on top of the $1.9 trillion tax cut that is part of the Tax Cuts and Jobs Act, which is most likely to continue. So how will these potential tax cuts impact us on the nation's debt, the value of the dollar, and will this create a recession?
All right. Well, thanks, Jaime. Happy to be here in this time of really relative little change since the last presidency. It's the last administration. It seems like nothing's changed at all. Everything is up in the air right now. There's still a ton of uncertainty. We talked about this last time, and we were going to wait and see what happened. And uncertainty, I don't want to throw chaos out there, but there's a lot going on, and it's really hard to figure out where we're at because I know we'll talk about this throughout the conversation, but just using tariffs as an example, there's tariffs thrown on and then they're taken off, they're delayed, retaliatory tariff. I mean, it's just, there's people laid off.
Yeah.
The courts intervene. The initial decision may be far against the administration. The next decision on the appeals may be the opposite of that. So we're all over the place. And there's just a lot that's going to have to be figured out over the next, I would say months, but maybe even years on some of these things that are going to be court challenges, but certainly a lot of chaos. One of the things that's a priority for this administration coming in was obviously to continue with the tax cuts that were already in place from the prior time he was elected, to put those back in, or keep those in place. They're in place, but they're set to expire at the end of this year as far as the personal tax cuts. So that is the goal number one, is to keep those in place. There's a chance that we could see additional tax cuts in there. I know on the campaign trail that Trump talked about no tax on, servers money, no tax on Social Security and things like that. I don't know how much traction those things have and how many will be pushed into whatever tax cuts we end up with here at the end of the day. So the other thing that I think Trump has been focused on, or his administration, and we see it through these DOGE cuts, is they're trying to cut back on government expenses, meaning they're trying to cut back the amount of money that the government is spending, and tax cuts would have a net benefit on consumers, regardless of what the government does, right? If we have more money in our pockets, we're gonna spend a little bit more money. So that's a net positive for the economy. As you pointed out, it also is a potential gain for the level of debt we have in this country, if it's not offset, right? If it's not offset by other things. And one of those other offsets could be government spending. There's been a lot of research through the years that shows that the private sector is a lot more efficient spending money. There's a lot better returns when the private sector spends money versus the government. So in theory, it's a good thing if we're cutting government spending and we're passing it on to the other side, and the other side is spending it more efficiently. They've got shareholders that they have to, our boards of directors that they have to talk to and make sure that they're doing the right thing with that money. I'm not saying that always happens, but again, theoretically, that is what will happen. So to make a long story short, certainly we could see a larger budget deficit over the ensuing years. I think during Trump's first term, there wasn't really a priority to trim the budget deficit. So we saw it under the prior president, it was high, it continued to get high, and then it continued through the last administration. So if it continues on to continue climbing, not surprised. I think whether you hate or like Doge, and there's certainly a lot of energy on both sides of that argument. Those that are far and that are against it. The premise of cutting waste, becoming more efficient as a positive thing. We all know that the government deficit is, and our well, I don't even know how many trillions of dollars we have in debt now, 35, 40 trillion. So it's some crazy number, right? That when you break it out by individual in this country, it's unsustainable. So we have to start going in the other direction. Um, there's a chance that's going to continue to climb. It depends on what tax cuts come out. Again, there's still a lot of uncertainty on what the final thing will be, and then what offsets we have, or what are they going to cut on the other side of government spending, and is there enough government spending to cut? I think you could probably make the argument there isn't enough that could be cut that you and I are going to be happy about. Could you start cutting entitlements, especially things like Social Security? People are not going to be happy. They've paid into this for years, and there's an expectation that you're going to get those things, certain things back on the back end. So, yes, these things are all on the table. We could certainly see issues with a continued levels of debt. As far as the recession goes, the likelihood of a recession this year has certainly increased, but I wouldn't blame it on any tax cuts. I would say there are other things out there that we'll probably talk about. Things like tariffs could certainly impact that, especially if we get into trade wars. That's a net negative. Tariffs are a tax, basically. So on the one hand, they're talking about cutting taxes. Enacting tariffs is doing the opposite. It's raising taxes on certain items. So it'll depend if they're used as a negotiating tool or not. So again, I would love to say with a lot of certainty what's going to happen, but I think we're still really early in the game. And the next few months, kind of like the Fed at their last meeting said they're going to, they're comfortable sitting back and waiting. I think that's kind of what we have to do right now, is sit back and see what the next few months brings us.
Okay. Well, Scott, you said it several times, tariffs. So Tim, let's talk tariffs. What are the threats and the benefits of the proposed tariffs, and how will it impact the economy?
I think first, Jamie, we have to know exactly what the tariffs are going to be. And to Scott's point, I don't think we or anyone has nailed those down yet, right? I mean, it's, over broad-based sets of goods, they're on, they're off, there's a month reprieve, they're back on, So, the reality is it's really hard to say what the ultimate set of tariffs that we're obviously going to see, or who knows, maybe not, will cost for the economy. But in a general sense, I think we can talk about, what are good uses of tariffs, what could be good outcomes, and what maybe not so good outcomes. I mean, a couple on each side, I guess. Benefits of tariffs is you can protect industries, right, that are important to you. Certainly, we've seen the U.S. do that with the steel industry. In 2018, we implemented some fair-sized tariffs on the steel industry as some of our trading partners glutted the market with cheap steel, mainly based on subsidies that governments gave to their steel producers. So it's difficult to compete on the world stage when that's taking place. So you can certainly use tariffs to protect, industries that are important to you. We see the ones that are the big talking point now are obviously the Canadian tariffs that they implement on their dairy and lumber prices, right? You're up to 200% depending on time. So those are the type of things we're talking about, trying to protect industries in your country that are important from trading partners that maybe aren't doing things as you would wish. The other thing can be to protect workers against unfair labor practices, right? If you run tariffs right and you tariff those that are, significantly underpaying workers or subjecting them to, working conditions that are unfit, hopefully you can change those outcomes for people, right? And protect your workers, the fact that you're treating them well and the costs are more costs around doing that you can level that playing field somewhat. So those are some good things that you can do with tariffs if they're implemented properly. And I think, we've seen some of that over recent history. I mean, what can come out of them not so desirable, I think, to state the obvious, they can be certainly inflationary if they're kept on for long enough, right? I mean, obviously, as Scott pointed out, we're basically taxing goods, right? And what we're talking about here isn't certain industries like we talked about steel, or we talked about Canada with lumber or dairy. It's a broad-based tax, right? So that can certainly be inflationary if those tariffs are left on long enough. If Scott said we enter a trade war and it just keeps going tit for tat, so to speak, certainly can be inflationary. The other thing to do, and maybe even more importantly, is it hurts growth, right? Scott, talked about this a little bit too. We've seen some already adjust their GDP estimates for 2025 based on what's going on, because it just gets harder to do business, right? Obviously, harder to sell product, especially if you're exporting that product. It's more difficult internally because raw materials prices are rising. You're not sure what the business environment is going to be, so how much do you produce? And we've seen some of that take place when tariffs were the game back in the prior Trump administration. It was difficult business environment to be in, so certainly it can hurt growth. I think the biggest thing right now is exactly what we talked about and what Scott talked about to start off is just the uncertainty with it all. That just adds another layer of complexity to it. I mean, the tariff is bad enough, but then the uncertainty by which these are being implemented causes some chaos. And I think there's a reason you're seeing the market gyrations that we're seeing. The call is for volatility not to settle down anytime soon. So, you're likely to see market gyrations, not only in the stock market that we've been seeing. I mean, we've seen, some flight to bonds as people try and escape the volatility in the stock market, which has pushed yields down a bit. So I think all these things are coming out of this. And, I think we're just in the first quarter, obviously, of this. I mean, you never know. With the administration, they tend to make adjustments quickly and on the fly. So we'll see. But for right now, I think, chaos is the rule of the day.
Okay. All right. Well, I think the next topic we have to talk about is jobs. Adds another hot topic going on right now, specifically federal jobs, as a result of the Department of Government Efficiencies, we've seen approximately 65,000, federal workforce and contract jobs cut. And there's still the potential for more of that to come. And then, as far as employers, it was kind of announced that 222,000 jobs were cut so far in 2025, which is the highest we've seen since 2009. So, Scott, how is this impacting the unemployment system, the unemployment rates, and the job market as a whole?
So there has been a lot of job cuts here recently on the government side, right? DOGE came in. It seems like I think 65 to 75,000 employees, if you remember, DOGE came in and said, it was a voluntary, if you take this offer by a certain date, you'd get some kind of severance on the way out the door for a year or something. It was pretty, so some people took that. They said about 75,000, and who knows? We don't know what those people were going to be doing in the next year or two. Some of those might've been new retirees, and maybe they were retiring in the next few months and they saw this as a great opportunity. Certainly some of them maybe probably didn't like their job or didn't like their new administration or where things were heading, so they maybe took it too. So about 75,000 or so voluntary folks. Then I want to say 100,000 or more of these probationary employees that were let go. The other thing that happened is they instituted a hiring freeze, and the government hires about $200,000 workers a year, 200,000. So if you look at that, that's another 200,000 people on the sidelines for now that could be employed in relatively, good paying jobs. Government jobs, federal government jobs tend to be, some of the better paying jobs. And then we have some of this private sector stuff that's tied to government, right? We have a lot of folks that are in the private sector, but their employment is tied to what's going on in the federal government side of things. So what you alluded to, the 200 and, the higher number we had of initial jobless claims this past week, and it was about 20,000 more than anticipated. So a little bit higher than expected. We've been in this 200 to 250 range for quite a while now, where we've been relatively steady. So what we'll have to keep our eye on is over the next few months. It's a really good indicator to look out. It comes out once a week on a Thursday morning. So look at initial jobless claims, and then also look at continuing claims, which are printed the same day at the same time. and look for trends there. If we start to see that number get up to the, higher 200,000 a week into the 300s, that's certainly cause for concern. I would keep an eye on that. Again, there's just a lot of uncertainty, so it's hard to know. Some of these folks that were let go, there may be people hired back in their place because there's a position that actually is needed, or I'm sure there are many that were let go or that left that their position is needed. Maybe they didn't want to come back to the office, but in any event, there's going to be positions to fill. So another part of this is the data is, it could take a while for the data to show up in the numbers, even though we know what's going on. So, somebody that gets laid off, in March, but they get a 4-week severance, they're really considered employed through April. So then that doesn't show up for a month or two down the road. Somebody that gets longer severance or deferred type of thing, it may be, 6 months or so before it actually shows up in the data. So the data is lagging, I would say, but certainly look for trends over the next few months. And right now the focus is on the government sector. But certainly this, with all the uncertainty that Tim talked about with tariffs and everything else, this could push over into the private sector, and we could start to see layoffs there too. And that's where it gets concerning. And even before the layoffs, people will they'll look at the data, they'll see other people losing their jobs that might be their neighbors, and then they'll start to cut back too, right? Because they're concerned that it could be them next kind of thing. So it all bears keeping an eye on. So every Thursday, keep an eye on that initial jobless and continuous claims. And then the first Friday of every month, we get the unemployment data, the unemployment rate, and then the number of new jobs that were added or subtracted from the prior month. So those are all good indicators on the employment situation.
Okay. Another, topic that seems to be in the news is home values, specifically in the DC area. I was reading that the home values in DC have decreased 20 to 25%. So, Tim, do you think that will continue? And, how then does that affect other markets in regards to housing? And, what impact will it have then onto credit unions?
Yeah, it's interesting, Jimmy, and certainly, the DC area is its own little micro economy. It always is to a certain degree, but particularly now, right? There are some things happening in DC that aren't necessarily happening elsewhere. So we have to keep that in mind. Obviously, I think too is I think some of those reports on home prices crashing may be a little bit overblown, online. But certainly we can see the makings of significant declines there, right? It's no secret if you put people on the unemployment lines and, we're going to drastically cut back government jobs, then there's going to be less requirements for housing in the DC area. There's no doubt about it. So, we'll see what happens there. I think in general, the general housing market, median home prices have fallen back somewhat. Some of that was due to, mortgage rates rising. But we're still well above where we were at, say, before COVID times. So median prices for homes are still high. Supply is up year over year. So that certainly helps some. But probably more importantly is kind of the recent downtick we've seen in mortgages due to bond prices. And, if that continues, that could be a good thing here going forward in 2025 for, home sales, all else being equal. However, certainly that might not be the case in DC. And then, if what we had talking about comes to pass and we see, possibly recessionary times or things like that, that'll obviously counteract that the other way. But those are things we just don't know right now. But I think, overall for credit unions, there could be some opportunities this year if, the job market remains decent, the economy keeps plugging along and we see some relief in rates. So.
So we're discussing a lot of things, and one of the words that you guys keep using is uncertainty. So Scott, with everything we've discussed and all this uncertainty, I'm hearing the term government recession a lot. So, what are your thoughts in regards to this government recession?
Yeah. So that you're right. Uncertainty is kind of that's like if there's a word of the year, I think at least at the beginning of the year, it's certainly uncertainty. There's a lot of unknown. As far as recessions go, I think coming into this year, through Trump's first term, especially when COVID came and we were dealing with COVID, through Biden's term, and then into Trump's second term, spending the government has been spending large. They spent a lot of money to keep the economy afloat, to keep things going through COVID. The country shut down for months, and even after that, so there was a lot of impact. So a lot of money was thrown out there. And has still been sloshing around. So, right, that's been helping the economy, whether you like the fact that it's out there or not. So I think now the issue is that we could see that. I don't want to call it a gravy train, but it's, we could see some of that money dry up, certainly for a lot of people. They're talking about cuts to all these different programs. You look at USA, they distribute a lot of money globally, but there's a lot of US places that receive money. You look at the universities that receive billions of dollars a year to do research, primary research and things. So a lot of that could dry up, not completely, but just be cut back on things. So there's a lot of potential for the government spending to stop. So the flip side of this is the consumer, is private business going to step up to the plate and start spending more money. And this, as Tim talked about, this high level of uncertainty is not something that companies like to deal with. It's really difficult to make decisions. It's hard to say, should we invest in this new plant when we don't really know what's going to happen down the road? If you look at GDP in the first quarter, it's looking like it's going to be negative in the first part now, because it's not really due to anything other than the fact that because of all this uncertainty with tariffs, a lot of companies, they front loaded and started buying a lot of products or supplies they needed to build out their products. So our trade deficit increased, and it hasn't been seen in other parts yet, but it should by the end of this quarter show up elsewhere. But any event, the uncertainty is not a good thing for companies and everything. So coming into this year, early in the year, even the chances of any kind of recession were minor. I would say, there's always chance for recession, and the markets, when you looked at Bloomberg, they were saying about 25%, and Bloomberg just basically, they will survey a bunch of economists and they'll get their opinion. So they were getting about 25% chance of recession. That number hasn't been revised yet, but certainly there's a lot more talk about recessions this year. First half of the year, we're probably going to be fine because nothing's really kicked in yet. There's a lot of things that are still outstanding. But the second half of the year is where it gets a little dicey, where we could certainly see some issues there, especially as we talked about earlier, if the unemployment rate deteriorates, if employment in general gets worse, if the tariffs, as Tim talked about, if it does turn into a trade war and we're all paying a lot more for things, we're going to, the decision is, do I buy it or do I sit back and hold off, save more money, or just hold off because it's gotten too expensive? I suspect a lot of people are going to hold off. So the odds of a second half recession have certainly increased in the US. Again, there's still a lot that's in play that could impact that negatively or positively. So we'll have to see. But yeah, I would say the odds they're certainly north of 25% now.
Okay. All right. So Tim, before I ask you if we're looking at a rate cut or a hold next week, what other factors, is the FOMC looking at before next week's meeting?
Yeah, Jamie, I think they're doing what they have said consistently they're going to be doing, right? They're looking at a totality of the data, as they like to say. I mean, specifically, obviously, looking at what jobs are doing. We saw the latest jobs report for February, off just a little bit next to estimate, but a rebound from January that was likely affected by weather and wildfires and things like that. We don't know, but the jobs pictures holding in there, but has maybe weakened a little bit. We saw consumer, to Scott's point, talking about the consumer, we saw consumer spending drop off a bit, personal consumption expenditures in January. The consumer, fuels a large part of the economy. So that's always something to watch. Consumer sentiment has dropped off, just, same as businesses. It's very uncertain for the consumer as well, with all this going on. So consumer sentiment is taking a bit of a hit. We'll get another CPI reading on Wednesday. So we'll see where headline inflation is there. So they'll be watching, the same things that they typically watch, as well as watching everything that's going on as far as the administration's policies and, what is being worked out, as we go here. So they'll be taking all that into account.
Okay. Well, Scott, last week you were at the GAC, and I think you had the opportunity to speak with a lot of credit unions. What was the main topic of conversation? Are any of them concerned about liquidity?
Yeah, so GAC was good. We did get to talk to a lot of credit unions. Coming into this year, liquidity was a big question mark. We didn't know where we were going to end up. As we ended last year, internally, as we sat down, we thought that we may see liquidity tighten up a little bit based on historical numbers and projections.
Mm-hmm.
So we thought we would start the year with a little bit lower balances. We actually found that not to be the case. Our balances ended up starting the year higher than anticipated. And liquidity's held up pretty well. And that's kind of what I was hearing from most of the credit unions that I was talking to is so far this year, liquidity's hasn't been a concern. And really a big driver has been they've seen a slowdown in consumers borrowing. So their members aren't borrowing as much money this year. And I think we could attribute a lot of that to what we've been talking about here today is just all the uncertainty. If you're in the market for a new car, do you want to go out and buy that new car today when you're hearing about people losing their jobs, you're not sure where rates are going to go. Tim talked about folks that are buying houses. There's a lot of rate uncertainty. We're at lower rates than we've seen in a few months, but we're certainly well above what we saw, 3 years ago. When we had an average rate of 265, if people can remember that crazy rate for a 30-year mortgage, so we're still, 2.5, 3 times above that. So it still makes it challenging. Home prices, as he pointed out, are still high. So consumers are still they're kind of holding back right now this year so far on borrowing. And I think Tim and I, we were at a conference a prior week to that too. And we were hearing some of the same story that there's a little bit of a cutback on borrowing this year. No, again, this could change quickly if tariffs and things go away and there's tax cuts, consumers going to start feeling good again. Stock market goes back up. People will feel better again. So there's a lot of things that could change, but for now, the consumer seems to be in kind of a wait and see mode, I guess. Let's see what happens. And that's leading to higher liquidity at credit unions.
Okay. All right. So Tim, here's the question. What do you predict will happen at next week's FOMC meeting and why?
Well, I don't think this is a big secret. I mean, I think there's no way the FOMC does anything next week with rates, just because, I don't think the numbers at this point are pushing them there. And with everything else that's going on, they are still sitting there with their popcorn and soda and watching what's going on. And I don't think that changes for a while. So, I'm saying no action at all.
No action. Scott, you agree with his assessment?
Yeah, 100%. Fed on hold for a little bit anyway.
All right. Thank you both. Scott, any final thoughts for our listeners today?
I would just say buckle up. It's a year of uncertainty. Is really, like we've said a lot throughout this call. There's still a lot to figure out and to understand. We have a potential government shutdown looming in a few days or a couple of days. So that bears watching. Generally speaking, they find a way around that. They'll figure it out and continue on. But really, it's what we've talked about today: tax cuts, value of the dollar, potential of a recession. All these things are weighing on consumers' minds. Consumers are the biggest driver. We are the driver of the economy in the U.S. We power this economy as consumers. So if we cut back on new car purchases or other items, big ticket items, then certainly it'll have a negative impact. It'll be self-fulfilling that we'll hit a recession. So hopefully, things get straightened out sooner rather than later.
All right. Tim, any final thoughts?
I agree with Scott. Keep your head down, your eyes open. For those of you that like to run scenario analysis, it's certainly as good a time as any to pay attention to what your analysis is telling you on either side of your baseline, because, like you said, Jamie, the theme of this whole thing has certainly been uncertainty, and I think that's the flavor of the day. So,
All right. Thank you both so much for joining me today. Really appreciate you taking the time. This episode of Financial Minds is brought to you by Vizo Financial's Education. Education comes in many forms here at Vizo Financial. We've got workshops, conferences, and a lot of free webinars, to just name a few. But did you know Vizo Financial also has a blog? That's right. Each week, one of our internal experts or our partners provides an article on a variety of topics. Those topics include risk management, cybersecurity, compliance, payments, leadership and culture, ALM, investments. There's so many more topics as well. So subscribe to the blog today and receive alerts when a new article is posted. And you can learn more about the blog at Vizo Financial's website, www.vfccu.org. As always, thanks for listening and make it a great day.